Hello, everyone. Tonight, a data avalanche hits the markets this week. CPI, non-farm payroll. The market seemed to like it yesterday, but definitely not today. And the Dow hits 50,000 on Monday, 50,150 on Wednesday, not today. What is going on underneath the surface? And tonight, for the first time, I dig into two of our four portfolios, covering every single holding and why you need it there for your growth. It's Thursday, February 12th. I'm Charles Brown, your portfolio manager from Chicago. This is CB3 Live. We hope you're faring well in this cold, cold winter, unusually cold, but the show's going to warm you up. We have a lot of material to cover. In fact, I think I warned you in today's email heads up that this would be a long show, and that's okay. I'm even going to be willing to send you the slides from this show if you want to see it. If you're a client, and this show, more than many others that we've done, is going to be client centric. And I think it's time that we do that because we've made some substantial changes to two of our programs, and we want to cover that tonight. So let's move forward and go from here. Always adapting. That is our theme for tonight. So I mentioned the data avalanche. We want to cover the January jobs report and CPI, what happened with that. Dow 50,000, that's a milestone. Notice that it only crossed 50,000 just Monday after lagging the S&P and the NASDAQ and the Russell, but it did manage to hit new highs, but it sure didn't last long. And then again, tonight's show is all about what these shifts mean for your money and how we're positioning you ahead of this curve as we continue to implement new technology to benefit you. This is how we're always adapting to the markets. So the monthly market review, here's the scoreboard. This isn't even the close for today, so it's actually a little bit worse than that. All right, S&P down 1.3% on the year, NASDAQ 2.5%, Russell barely up. I'd be surprised if that number holds, though, because I had to stop my inputting of data about 2 o'clock this afternoon. A little bit better overseas, and the bond market really hasn't moved much at all. But the NASDAQ and S&P in negative territory here in mid-February, not a real good sign. But again, we had a nice strong start in January, so we'll see if the market can shake off these blahs. There's a reason for it, and I'll definitely get into this as the program progresses. So the engine of the market is earnings. It's earnings and interest rates. I talk about this all the time. So the situation right now is we are in our 10th consecutive quarter of year-over-year earnings growth. The beat rates, though, on average, are not crushing it like they have been, but we're meeting expectations. And that is not a bad place to be. 73% is the norm. We were in the low 80s the last two quarterly reports, and now that's falling off a little bit simply because demand is dwindling a little bit, but the revenue growth is broadening. See me underlining that beyond the Mag 7 into industrials, financial, and healthcare. And you'll see in the footer here, we'll cover that, why I have moved some of our holdings into those sectors. I should say some more of our holdings there. Goldman projects 12% S&P return. They have not backed off of that in view of what's happened just this week with some AI shocks, which again, I will cover later in the program. But the forward outlook is the PE ratio at 22.2 is about in line with the 5-year average of 20.0, a little bit higher, but it's richer because these big AI companies are still reporting solid earnings. And it's not like 2008, 2009, or more importantly, 2000, 1999, 2000, 2001, when they were just vapor companies that didn't have anything, and they were just saying, hey, we're on the internet. All right, so this is not the case now. We have genuine earnings here. And the GDP forecast of 2.7 is a little lower than we would like, but it's definitely higher than it was 5 years ago. So we are looking for communication services to outperform. We're actually neutral on technology, and technology is 37% of the S&P 500. And that's part of the reason that we've made the changes that we have, because technology is, so to speak, letting us down. Industrials outperforming, consumer discretionary actually underperforming. There are three sectors: technology, communication services, and consumer discretionary, that are the three principal drivers, well over 50% of the S&P 500. And you have one of those that's moderate and one that's on a sell. Fortunately, not all three are. Communication services is still strong. Healthcare is set to outperform. So those are the areas that we are especially looking at to add to your portfolio. Here's the drama that's making it complicated. This is nothing new. You've seen some of this, but I put the date lines here just so we could cover it. So Trump began threatening tariffs, and again, he was doing this back in April. This is nothing new. In fact, he started when he came into office saying, hey, pretty soon this is going to happen. All right. So that 10% by Feb 1, 25% by June 1st, the S&P drops 2.1% in a day, which was not as bad as it dropped back in April. Okay. So DeepSeek R1 shocks an AI trade. NVIDIA suffers its largest one-day loss in tech history. These are really big, dramatic moves. And then Feb 1 comes and goes with no tariffs taking effect. Feb 6, India tariff lifted. after Modi agrees to restrict Russian oil purchases. You're getting the pattern here. Trump is almost just trying to see how big a muscle he has, trying to muscle a huge economy like India. And if you sell oil to Russia, when we have them under tariff watch, we're going to punish you. So Modi, genuflected to that, if you will. And this Feb 20 ruling, so that's just in 8 days. That's a really big ruling. And it'll be on a Friday because if it's going to have an adverse market effect, they want to have the weekend to cool off. So this effective UF tariff rate is 13.5%, the highest since 1946. And it's definitely affecting average household costs. You can see the last line there, $1,300 in 2026. However, you always can decide to buy American products. Now, I know you don't have to type in the chat box or send me nasty emails. I understand that there are many parts that are coming into this country that are foreign made, that are built into American products. But there are still choices, especially in food consumption, where you do not have to buy products made in other countries. So some of this inflation on us personally is self-induced. So we have a choice in that area. So AI, the Fed, and what's ahead. I thought that was a cute little rhyme. But this is what we're seeing for the rest, really, of the year. So this DeepSeek is proving that this AI can be built cheaper. Now, that certainly scares the big companies that are building these enormous data centers. And so that's why you're seeing these shocks to the economy there. Nothing compared to what happened 57 hours ago in the financial sector, which we'll get to in about 30 minutes. All right. So hyperscalers doubling down, saying they're going to spend basically $500 billion in 2026, which is 1% of the US GDP. Let that sink in. Hyperscalers, these are the people that are producing these big data centers, are saying they're going to spend $500 billion and become 1% of the US GDP. 2 years ago, this wasn't even on the radar, folks. Certainly not 3 years ago. But here it is right in front of us right now. So the new Fed chair takes the reins in May, watching to see if that's going to be policy continuity or divergence. I'm going to bet on the latter, all right? The SCOTUS ruling could invalidate 61% of the tariff increases. That will be the single biggest shock to the market. It's going to dwarf what April 7th was, all right? The low of last year's market. And we'll get to April 7th a little bit later as well. But I don't think there's 5 votes to turn this against Trump. I just don't. The Greenland tariffs escalate 25% to June. They're going to have a deal signed before then. Trump's getting very antsy. Again, I already mentioned the new Fed chair, semiconductor tariffs. I mean, Trump is tariffing his way to terrorizing countries that don't go along with him. All right, so these are the two competing forces. Look at the bottom there, CB3 positioning. AI-fueled CapEx, that's capital expenditures, is bullish, but tariff-driven inflation uncertainty is bearish. And both of these are very powerful forces, both of them. And they're in play on a day like today when the market went up to new highs for just a few minutes and then sold off like crazy in the afternoon once PPI came out and was fully digested. So just remember, we don't predict these headlines. I'm telling you what could happen here. We prepare for them because our ability to react is always more important than predicting. You well know this chart. 293 of the 500 S&P 500 companies have reported. The leaders are staples, energy, healthcare, technology, and communication services by some pretty big beats. I don't like seeing financials at 75, industrials at 74. I don't really care about real estate. Nice to see technology and communication services that high. By this time next month, and the next show is exactly 4 weeks from tonight, only happens once a year with February and March. And that's only 3 out of 4 years, but I digress. Okay. So that's going to be the telling factor next month at this time, is where we are on this chart. So let's look at the employment scenario. Now, normally I wouldn't cover this in too much depth because the employment data comes out the Friday after our Thursday show, but it was delayed because of the partial government shutdown. So we're actually getting January's really late here a few days ago, 2 days ago in February. So Non-farm payrolls up 130,000. Expected was 70, so that's a really good number, right? I mean, that's a blockbuster number. Unemployment rate 4.3, which is up from 4.1, but it was expected to be 4.4, so that also is a beat. Doesn't really matter what it was. The world expected 4.4, should I say the economists of the world expected that, and it was better. Average hourly earnings 3.7%. So previous was 3.9, 3.7 is a little soft, but still growing. And labor force participation at 62.5, just under 2/3 of the economy. A normal benchmark here is when you have 2/3 of the economy working, that's humming along pretty well. That's about 66, 67%. We're not quite there, but that's the data here and what matters. So wages and employment, look down here at the bottom on the left-hand side. Wages above CPI means purchasing power gains. Wages below CPI means consumers are falling behind. This is a really important concept to understand. If inflation is at 2% and growth is at even 2.2, we're going to be fine. But if inflation's at 2%, and I would love it at 2%, if it's at 2.7% and growth in wages is 2.3%, not so good. Because then you're just not keeping up and you're living a deficit lifestyle, probably using your credit card more than you should. So the pre-COVID low on the right-hand side was 3.5%. This natural rate, the natural rate means what is the normal historical, going back 50 years, what is full employment? You're never going to see a 0% unemployment rate because some people just don't want to work, all right? So what is this, as they call it, natural rate? 4 to 4.2, and we're happy with. So, we're at 4.3 right now, not so bad, all right? Just not so bad. And the Fed's dual mandate, which you know, I talk about this, the maximum employment and price stability. That's what they're just trying to weigh each and every meeting that they have. And this is why Trump and Jay Powell are so out of sync, because Trump says, you got to drop rates. The employment's fine. Don't worry about that. And Powell's saying, nope, we got to take both into consideration. So where are these job gains and losses? Lots of in healthcare, social assistance, construction, federal government job losses. I'm glad to see that. Frankly, our government's too big. I'm sorry, but I digress. Fed rate path 3.5 to 3.75. So that's where the Fed thinks it can get rates down to another quarter point, maybe quarter point beyond that. And could see a 3% rate by the end of the year. Again, depends on who takes Jay Powell's place. It's going to be a really interesting second half to the year. But if we have strong jobs reports and a hot CPI, meaning a high CPI, consumers spending, consumer price index is high, then there just aren't going to be any more rate cuts, at least until June, and maybe not one until then. Again, depending on who is going into, now we already know who's coming into. Warsh is coming in to be the Fed governor if he's approved. So do not assume with a very tightly divided Senate, and it doesn't matter about the House, the Senate's who's going to decide this. We got some rogue Republicans in there, or should I say the country has some rogue Republicans. This could come down to a 50-50 vote with J.D. Vance doing the tiebreaker. So, but our assessment is strong beat keeps the Fed on hold. June remains the base case for the next cut. I can live with that. I'm fine with that. I want to touch briefly on inflation. So the headline number, 2.9%. We covered this a little bit earlier in the non-farm payroll, but previous at 2.7, the core CPI at 2.7. Remember, that's ex food and energy. So there's two different numbers for CPI. One is without food and without energy, and the other is everything. Well, food and energy are two things we can't do without, right? But they're very volatile because of that. So sometimes if you really want to get a pulse on how inflation is, you do an X number for CPI, and that's what they're showing here. So month over month change, 0.3%, not terrible, but the Fed target's still, about a third of the way from being where it needs to be. So the core CPI 2.7, the Fed target at 2. The tariff impact continues to raise this. And, only so much can we change our spending habits to just spend domestically, but we still could do more. In my opinion, I'm buying nothing foreign if I do not absolutely have to do so. So where is inflation hitting the hardest? Where is it hitting the hardest? Hospital services, no surprise. My wife's spinal surgery was over $250,000. Crazy. And this college tuition, I don't know how all these colleges are going to keep going. It's up 200%. Look at this data, 200%. 196, we're going to call it 225 years. Childcare. My daughter in New Hampshire benefits from that because she's in the childcare supply business as a nanny agency. All right, medical care, housing, that's all right there. Only thing really going down are TVs and computer software. And again, those are negotiable because you can get a TV almost anywhere. In computer software, there's almost always a competitor for it. But these other areas, you're really stuck with it. So the real cost of living on the right-hand side, services versus goods, essential services you can't avoid. Healthcare, education, housing have surged. Consumer goods you can shop around for have plummeted. There's some benefit in that, but the sticky numbers are the consumer staples, things that we have to have. There are many people that think the CPI understates this reality. I don't think it does. So I think we're not in a great place, but we're not in a terrible place. And why do I say this? Because look at where we were in June of 22 and then down in December. These are 6-month bars, okay? June of 23. And that's basically where we are right now. We're in mid-Feb of 26 and we're back to where we were in June of 23. And the CPI has just kind of flustered around since then, but the Fed is determined to get this down to 2. That is their mandate. And again, this is their mandate as enforced or encouraged by Congress. So it's not just the Fed picking some arbitrary number. This is part of their chartered mandate. We are moving in that direction though, okay? So the CPI components, last slide here for CPI, shelter and housing up, food at home up, energy up, used vehicles down, medical care up, transportation services. This would be insurance, okay? Airfares, auto insurance, much higher. The current Fed funds rate, 3.5, 3.75. I think that we possibly will see this to be 3 at 3.25 by the end of the year. That would be wonderful. That drops long-term interest rates probably by a full 1/4%, maybe a full 1/2%. Probably not, but maybe. Depends on how the long end responds. They don't necessarily move in lockstep. But that means mortgages refinancing. It also means more people will put homes on the market because there are more buyers when rates are lower. You see why we all want rates lower? Except the banks themselves. They want rates at, 22%. But I digressed. All right. We are always adapting as your money manager. That's just the way it is. And that's the way we want it to be because that's what we bring to you. That's the value, that's the value add that we have as a portfolio manager. And I want to walk through the business here just a little bit so you can see how this works. I want to welcome John Connolly back from medical leave. So good to see you, John. All right. And who else do we have here? I think Nellie. Yes, Nellie, good. And Socket One, do I know who this is? I don't know. Andre from New York, good to see you guys. Thanks. So here we are, always adapting. This is a segment that many people have asked for because we're going to cover, there it is, the elephant in the room. And that is performance of our programs. Between this show and next week, next month, I should say, we'll have a deep dive into CG and MP, a new portfolio, this show, and then next week GI and DS. No holds barred. Type the questions in the chat. I'll answer anything you throw at me, okay? So let's first start with a premise of why we believe you need active management. All right, it's buy and hold / hope versus buy and manage. So on the left-hand side, passive, people that just say, you know what, I'm going to put it in the market, I'm going to leave it there, I'm going to hold, and I'm going to hope. And that's fine. You buy the index, you never touch it, no risk management, no cash management. You ride the entire decline, every crash, no hedging, no signals, just put it in the market, put it in SPY. All right, the market always comes back. The problem is this was fine for many people on this call 20 years ago or 25 years ago, but our practice and most of the people watching this show are clients, and they're about my age. Some are older, some are younger. All right, the S&P lost 37% in 2008 and took 5 years to fully recover. So to us, hope is not a strategy. And that is the kingpin of this program and why we do active management. Now, doing active management means there are times that we are going to actively increase your return by saving you money on a downturn. But it also means there'll be times when we over hedge and you don't quite keep up with the index. When we underperform the index, it's almost always not because we've lost a ton of money. It's because we haven't made as much on an upsurge. And I got plenty of charts later in the program to show you this. So our active approach, and any active manager's approach, is they own the market, but they manage the risk. There's no such thing as not having any risk. If you look at the last line there, the real question isn't active or passive. It's whether you or your PM is portfolio manager, managing the risk. There is risk in everything you do. And if you're just buying and holding, you have assumed the risk. And I am fine with that. If you're comfortable and you're comfortable when to get out, get back in, those are two decisions that have to be made. The market goes down. Do you get out on a day like this? Do you get out on a day like April 7 when the S&P is down almost 5% in 6.5 hours? And if you do get out, when do you get back in? All right. So monthly signals, we have migrated from April with two major changes. The first is we moved to Charles Schwab, where we can do institutional level option hedging to limit the downside. This is extensively covered in episodes in August, October, and November of last year. Go back and check out those episodes. Just skip right to the part. There's even a separate video on our website just covering Schwab hedging. All right, so I won't spend too much time on this tonight, but just know that that's part of the reason. And we have, therefore, because we have this downside protection, we're using monthly trading signals. I'm going to show you a chart of that in just a minute. We're not trading on emotion. We're not exiting on emotion. We're not placing stops in the market like we used to do. We're using this core satellite architecture. We have been using that in DS with great success. Our 7-year track record in DS, just go to the website and see it, it's over 400%. We are just now migrating CG and GI to a core satellite methodology. And I will explain that in just a few minutes. Okay, hang with me. But active doesn't mean hyperactive. In fact, we're trading less now because monthly signals means there are less trading signals than with weekly signals. We were able to make this. Why? Because of the options hedging. Okay, discipline is the strategy. So in 2008, everybody got hit. Goldman Sachs down 60. Bill Miller, who's Bill Miller? You'll see in the next slide. S&P down 37, Berkshire Hathaway, good for you, Warren. But at one point during the year, Warren, I know it, it's not on the screen, you were down 54% and then had a miraculous recovery in the last half of that year. And we were down 36% as well. All right, so I'm not picking on these legends, but Bill Miller is very famous, Legg Mason, from 1991 to 2005, 15-year streak of beating the S&P 500. And when you have a winning streak that long, the good news is your clients love you. The bad news is you think, I don't ever need to change this. I'll put up with some downturns. Okay, I'm never going to change this. And that was his position until 2005 when the market went down. 3 years later, it's 2008, and his fund drops 55%. And 4 years later, he left the fund. All right? So heavy financial concentration, what doesn't matter? It's too much in one sector, lost 55%. His assets under management, that's a B, not a M. AUM collapsed from 21 billion to 2.8 billion. I never want to see that happen with you guys. Because if my AUM dropped from what it is by 90%, you will have lost a ton of money. And I will not sleep for the rest of my life, probably, if that were to happen. So I always choose defensive over too much offensive. But with the latest technology, with the options hedging and what we're going to talk to you about in our COIFIN back testing, which is just brand new, literally 2 months ago, we've been beta testing it, rolling it out in how we formed our portfolio decisions in February. Just give you another 10, 12 minutes, okay? It's there. And Kathy Wood, you probably heard the name ARK, right? So 2017 to 2021, superstar, absolute superstar, best performing actively managed ETF in the world, massive inflows, all coming in at the high, all right? Her famous words, innovation is the key to growth. That's just what we're going to always do. Well, the problem was that in the downturn in 2020, it really got ugly. She fell 75%. The share price went from 159 to 40 because of her what we call single theme concentration. The closest thing we have to a single theme is really a tri theme in DS. We only have Mag 7 at different weightings, different times. And we have AGI, so that's AI, but generative I, so AI really has morphed to AGI. We just don't call it that. It's too many words. Artificial generative intelligence. And then quantum computing. And we're piggybacking on that data centers because it's all tied together. And that's the very narrow theme in DS, all right, which has worked very well for us. So most investors lost a bunch of money. Her assets went from 28 to 6 billion. So what is the lesson that I've learned by watching these two? Single theme, high conviction portfolios create spectacular runs. Yeah, I thought I had a spectacular run in 2020, but not so compared to Kathy Wood. You'll see that in a second, all right? But how do we participate in this grind of the S&P higher at the lowest possible risk? And I need to say this on camera, folks. We want this market to do great for all of us. But when it's not doing well, I have to protect your portfolios. I have to do that, and I will give up some gains to do that. If I can use better strategies to give up less in downturns, and you'll be seeing this in 20 minutes, what we have now that we're super excited about. Just again, technology did not exist 2.5, 3 months ago. Okay, so that's where that is. So this is the pattern, all right? Down 55% for Bill Miller, assets dwindle, Kathy Wood. But even with her incredible year, I mean, we were up 62%, but that's nothing compared to what she was up. And yet we were up 62% in 2020 when Berkshire was up 2.4%. That was one of my proudest moments. We just shellacked Warren Buffett that year. But it's really difficult, folks. It's really, really difficult when you are running a high conviction portfolio and you can get ahead of the market too far. I'm going to show you the perfect chart for exactly what happened. And you CG players that have been with us since 2020, some of the people on this call have been with us 20 years, okay? We have one client that's known me for 55 years. Hadn't been with me all that time because I was only 11 when we, 14, 15, whatever I was when we met. So anyway, that's the reality there. So this is our, and I just picked a random blend of our three programs here because we didn't have MP back then, but I just went back to 2020 and I did a 40% CG, 40% GI, 20% DS, and that is our cumulative return. I should mention that if we were doing that February of 2020 to February of this year, we would be down several percentage points from that because February's been awful. And I'm sure you all know that because you've looked in your accounts and seen it. But as I continue to roll out the charts tonight and you look at various time frames of performance, I'm hoping you're going to understand why we do what we do and how we have these times of underperformance. We never want to see this, and we will not see this because I will step aside from huge gains to avoid ever having this happen to your assets. So always adapting our theme. I'm going to show you some tools. We're going to start with Capital Growth CG. Almost everyone has a CG account. Thank you, Nellie, for saying that you like the picture of me with the elephant. It took a lot to get that elephant in my office. We had to have clearance to get it up in the elevator. Squished it in there, but we got it done. So here's how we differ in CG today. It doesn't mean it's going to stay this way, but we differ because we're tilting. When a portfolio manager tilts, he's saying, that's the index, but I think this sector is going to do better. And this is a really important decision to make because the sector choice actually has a greater influence than almost anything, even individual equities, all right? So just realize that going forward. Industrials and financials. So what I'm saying, look at the line on the right-hand side. Heavy financials and industrials overweight reflects our conviction in the broadening rally beyond big technology. Financials and industrials are not considered high tech. And for years now, high tech, big tech, AI tech has absolutely dominated the landscape. And because we've had somewhat narrow investing in technology, we've missed some of that. So we are catching this now when industrials are really starting to catch up, really starting to catch up and catch on. Industrials and financials, we have big holdings in CGGI and not so much in DS because you know that theme is restricted. All right. We'll talk a lot more about that next month. We're underweighted in infotech. We're way underweighted in consumer discretionary. And I showed you why, because you saw how the returns were about 6 slides ago in the consumer discretionary. Why? Because people are not spending on things they don't need to spend. Why? Because inflation. They got to rechannel that money towards staples. Remember the pie chart that you see at the end of every month, and you saw staples were one of the best performing? That's because people are stocking up when they have money on toilet paper deals and facial cream deals and who knows whatever kind of deals, right? And healthcare, a little bit of downplay on that, even though healthcare has shown some pretty good returns. So let's talk about this restructuring. So 40% of CG is now SPY. And why are we doing this? SPY captures market beta efficiently. It leaves us 56% to concentrate on 10 alpha generating satellites. You're going to see what a satellite is in just a few minutes. It's a stock, and there's nothing new here. What we did is take the very best holdings in CG. We converted the ones that were not performing as well into SPY so that when the market moves higher and it is Mag 7 driven, or even just 2 or 3 of the Mag 7. And that is actually what's happened. You've seen NVIDIA, Google, and Amazon. I mean, Microsoft's been pretty weak lately, really weak. And so is Apple, although Apple now just today said Siri is going to be delayed, and then they dropped 6%. I mean, these kind of moves used to be 1-2% when a big bad news item happened, but the expectations are so high for these Mag 7 stocks that we're seeing these outsized corrections. Our institutional put spreading, if you go back and watch those episodes, you're going to see it was 2.5%. We have upped this to 3%. And the reason is because we see macro underpinnings here that we think what we saw today in the market might just be the beginning of a decent sized correction, not a bear market. That's 20%. But even a 10% correction we haven't had since April 7th to April 9th last year. We're going to look at that chart in just a minute. We had a 3-day correction because it went down more than 10%. It went down almost 5 in one day. And that was it. That was it for the whole year in 2025. But we don't know what's up ahead, and that's why we have to do what we do. So our solution is, since the Magnificent Seven is 34% of the S&P 500, but it contributed 42%. So get that. It was, whoops, sorry, hit the wrong button. What I'm trying to say is Mag 7 actually is proportionately smaller, but the outsized returns are larger. All right, you see what I'm saying? 42% of the recent returns, but it's only 34% of the market cap. So these are outsized returns no matter what. And if you have a portfolio like CG, which has no Mag 7, if we put Mag 7 in there, then it's just cannibalizing the DS program. And we don't want 2 programs, so there's no reason to have them. We want to be able to seek alpha, if you will, in different ways in CG than we do in DS. But how do you do that when 42% of the market is the Mag 7? Well, you do what we've just done, and you bring in SPY at a reasonably low rate. I mean, 40% is a pretty significant number, but it's not like 60 or 70%. All right, still gives us room with these satellites to get the overperformance. All right, it's making sense? January CG down 4.2% versus the SPX. We understand that. And that was with 17 holdings. So we are adapting. We're not drifting. We're deliberately upgrading for resilience. And I'm going to show you right now how we are doing it. So the number one holding is the core at SPY, 56% in the satellites, 3% options hedging, 1% cash. These are our satellites down below. They may not all be here when you come back in March. And here's why, because now I have a very short fuse for any stock that makes it to my Elite 10 in CG. There are actually a few more in GI, but I'll get to that next month. But for these 10, guys, if I'm bringing you in, you better perform. You better perform. All right, let's look at them. So before we do that, you're going to hear me refer to a buy signal. or a sell signal. So this is the part that we've developed, our software for our 3-channel buy system. You've seen these charts, but I want to bring your attention to the arrows there pointing down, which was the bear market of 2022. And then I'm bringing your attention to April of last year. That arrow points on one single bar. It pierces the lower channel. That's the 3-channel system. It went through all 2 of the 3. And because of that, we lightened our portfolio. We had to do that. That was our methodology at the time. We didn't have the technology, I should say, to back test hedged portfolios in April. Literally 7-8 months later, that has changed. And I'm going to show you that in just a few moments. All right, a little easier to see if I do it this way. I'll highlight that area. So we would have handled the bear market of 2022 and the April spike down much, much differently last year had we been in our current positioning, which I'm going to talk about right now. So this is SPY. 40% of CG is now SPY. It's an instant diversification to the S&P 500, full Mag 7 exposure, tiny expense ratio. It's not going to cost you but 0.09%. You won't even see it. Freeze the remaining 56% for these alpha generating satellites. All right. The number one here, you probably know this company, Palantir, AI and government defense. They're almost just, I would say, impenetrable because they have such a strong inroads. They have a perfect buy signal on the technical side. They have a unique dual moat, government defense contracts with the CIA and the Department of Defense, and explosive commercial AI platform adoption across Fortune 500 enterprises. Because of this, they are one of the most heavily shorted companies, meaning people are betting against it. But the bulls just continue to support this, and we are a big fan of it. It has our highest weighting at 7%. All right. The great thing is it's only 0.02% of SPY. And it's this lack of correlation that makes any of these stocks in here, any of these satellites important. You will not see any of these 10 that has a 5 or even 6 or 3% correlation with the S&P because that's too much overlap. We're looking for superstars that do not correlate with the S&P 500, right? All right. So BlackRock, the world's largest asset manager, you probably know who they are, 6% weight, 10 trillion in assets. Astounding. Sidebar, that's still less than Schwab has, but Schwab's not an asset manager. They're a broker. So 10 trillion in assets pretty much makes them the toll booth for global passive investing, every dollar flowing into their index funds. And we use their funds, as do millions of other investors. So they're on the ETF platform, tiny 0.4 weight, all right, overlap, genuine alpha exposure. We like BlackRock a lot. CBOE, this is one of my favorites because this is the Chicago Board Options Exchange. All right, definitely on a long signal here, and they own the VIX. Now, the VIX is the risk management benchmark. And so on a day like this, the volume on the CBOE skyrockets. Why? Because people are buying puts because they're freaking out. We're not buying puts today because we already bought them. I mean, we're not buying puts on days like this. We're buying them only 4 times a year and positioning you so that when these days happen, you have purchased your protective puts at the lowest possible price at the most opportune time, which is when the market's going up, right? Not down. So 0 DTE, that's 0 days to expiration in the XPX and SPY options. And I trade some of these from time to time, but not to hedge, just to speculate. Why do I say this? Because I keep a good tab on the CBOE. And today was one of those rare days. There were 6 of them last year when the CBOE actually had more trading volume than the New York Stock Exchange. And again, this is on a down day. So I like CBOE a lot, and it has very little overlap, 0.06%. That is genuine alpha exposure. All right, JP Morgan, this is actually the largest overlap we have, and it's only 1.2. They are the largest bank by assets in the Western Hemisphere. So we have to rule out Abu Dhabi and some of those, but and China, frankly, but really strong, almost $4 trillion balance sheet, diversified across consumer, commercial, investment banking, asset management. They're not compared to BlackRock, but they have a very diversified business, 2.3 dividend yield. Now, that's the biggest yield we have for a stock in CG, and it's just an extra bonus because they are definitely a growth engine and a dividend engine as well. Okay, so 1.2 again, Spyway, largest overlap, but not a big deal. Broadcom, ticker symbol AVGO, a 6% weight wide. Does this belong in here? Again, 2 of our 3 signals really, really strong. The Bollinger Band just kind of neutral on this, but 2 out of 3 really strong. It acquired VMware and really transformed Broadcom from a pure play semiconductor into a diversified infrastructure technology company. That's a lot of words, but it's a way of saying, look, we're going to compete with the behemoth companies out there, and you need to pay attention to us. And when this happens, instead of hedge fund managers and pension funds buying millions of shares, they're buying tens of millions of shares. All right. And that's a good thing. So they're a hyperscaler, Google and Meta. They're driving growth well above averages for the semiconductor industry. It's a 1.8% weight in SPY. So actually, this is the number 1. I got that wrong. If you go back and listen to the tape, JP Morgan is the number 2. Broadcom's number 1 at 1.8. So we did trim this a little bit from its weight from just a few weeks ago before we made this core satellite adjustment. Okay. GE Aerospace, this is an aviation pure play, 5.5% weight. This is post the Vernova spinoff. It's a pure aerospace play, riding multi-year commercial aviation recovery and continuing new contracts. This could move into the defense area. They could overlap somewhat with Boeing. I just think this is a phenomenal opportunity. The spinoffs from GE have all done well, and so I like this. A very small correlation to SPY. I'm losing my voice here, guys. I'm going to need to take a break in just a second, but I'll get through these. All right. So genuine alpha exposure. Again, the goal here is to have very little overlap with SPY. We want to be able to get the Mag 7 and core holding industries in SPY without having to pay attention to any Mag 7 exposure in our satellites, which frees me to pick 10 and pretty high weights. I mean, some of these 5.5%, 6%, 7% in Palantir's case give us a chance for real alpha. What is alpha? Alpha is return over and beyond the market, which is S&P 500 index, or in this case, SPY. BWXT, Nuclear Technology Specialist. It is the only company commercially licensed to build Navy nuclear reactors. This is a big deal. All right, nuclear is where it's at for energy. And when you put one up in a town, first of all, you wait 30 years to get it done. But these smaller reactors that are powering submarines and other naval ships, this is a phenomenal company. Triple tailwind, defense spending increases, AI data center, nuclear demand. Where are we going to get all this power? It's going to be nuclear in some cases. You got to obviously find a country like Canada that's going to allow one in Calgary. But when you see these acceptance of nuclear powered data centers, it's just going to be a huge boon for this company. And so we really like this. Zero overlap. Okay, 0.02. So it's an ideal satellite. Rocket Lab, space launch and spacecraft. Second most frequent orbital launcher right behind SpaceX. And we all know that SpaceX probably is going to issue an IPO that'll be the first $1 trillion IPO. You heard that right. $1 trillion, maybe $1.3 trillion, making Elon Musk wealthier than most countries, maybe all but the top 30 countries in the world. One man. All right. But this company is the second most frequent. They have this medium lift rocket on track for an initial launch later this year. Major catalyst with some execution risk. Okay, vertical integration strategy creates a competitive moat. A moat is a good thing because it keeps competitors away, and that's what we want. All right, we trim this down from 10.8 again to make room for SPY, but 5%, nice weight, 0% overlap with SPY. Document database leader MDB or MongoDB. Okay, they're an AI application development which requires flexible, schemaless data stores. All right, this is pretty complicated. All right, vector search activity for RAG use case central to enterprise AI. I should have prepared for that a little bit better, guys. I'm sorry. But read there, just do a Google search. Nobody does Google searches. Go to one of your AI engines and say, give me 500 words on this company. It's really impressive. They have a great technical chart and zero SPY overlap, and that's what we want. And the last of the 10, this is the most volatile. This is the one that I'm not sure will be here in March, frankly, although I'm trying to give each of these stocks a full 2 months. But again, all of them have been in CG. All right, they've just had their weights reduced so that they could fit in. But these AI suite positions for generative AI era, I mean, enterprise consolidation, data infrastructures need this unified analysis and ML platforms. Again, zero overlap. We think these 10 stocks will give us significant upside and even somewhat protect us to the downside. Of course, the options hedging, so 3%, remember I said 2.5% was the norm last year. When we rebalanced here in January, we went to a 3% 20 delta option. What is a 20 delta option? You're going to see it on the next slide. Okay, so defined cost in insurance. That's what you need to think of. When you have, the time to buy insurance, if you live in Florida, like I did, and some of the viewers on this call still do, or did at one time, the time to buy it's when it's December and there are no more hurricanes, right? You don't want to try to get hurricane when there's a Cat 5 off the coast 300 miles. Nobody's going to sell it to you, right? So we're trying to protect against these sudden severe market drops that are more extensive than what we saw today. We had a pretty good protection today, which I'm going to show you. But we want to protect against something like this COVID crash, or if there is an AI crash. Now, how can there be an AI crash? Because it's growing so much. Well, because it's displacing traditional industries. We're going to get to all of that in this show. Now you see why I warned you that this could run a little bit long. But guys, you need to hear this stuff. You really do. So hedging is a small drag on returns in normal markets, but that's fine. It lets us stay fully invested with confidence. This is an actual customer account. This is a snapshot that I took at 2 p.m. today, Central. So these are the holdings. Portfolio's down 1.43%, but it would be far worse than that. I want you to look at the green line. That is the long put in this portfolio. He has 72 of them because of the size of the portfolio. If you're in the CG, you have this exact same, you just don't have the same quantity, right? He's making $21,000 to offset further losses on that. He is giving up $11,340 because of the short put. Again, I covered this extensively before, but I want to just, since you can actually see it on the screen, so that, I mean, you can imagine to save that kind of money, right? Let's go back and look at that one more time. It's going to cost you some money to buy a single instrument, even though you're buying 72 of them, that gains $21,000 on a day when the market's down 1.43. It actually was down more than that because the options are hedging that. So why do we just not buy long puts? Because they're expensive and they erode. So what we do is we short or we sell the 10 or 50 strikes away from where that long put is to bring in some income to help us pay for that protection from you. That's the entire strategy right there. We do it 4 times a year, and that's it in a nutshell. So I'm going to pause because I need some water. And I'm going to look in the chat and see if I've missed anything. Guys, now's the time. It's a 20-second delay. Pound me with questions, okay? All right. Okay, let me see. Oh, wow, I went through all my cough drops. I got to get one more, guys. Sorry. Oh, sorry about this little pause here. Andre, walked by the new JPM building in New York City, and it's something. Yep, broadcast strength from, I bet. Yeah, JPM is a bulwark of our economy. Avago does, Nelly, AVGO. But actually, that's going to be broken down. Not in this report tonight, but you'll be able to see that because I want to tell you all about COIFIN and the advanced reporting that it offers. So like this methodology makes sense to me. Thank you, John. We hope so. We hope it's going to make sense to everybody. So let's look at the mini port. All right. This is a brand new portfolio, and we did it because we had to. So Schwab does not yet offer the capability for advisor managed portfolios. So if you're just a person going there on your own, you can trade in fractional shares, but you can't do it as an advisor. So that opened the door for us to develop an institutional quality strategy accessible at much smaller account sizes. So that's how this was born. The purpose is designed to make it as a placeholder, a way for clients to begin investing with us with active management discipline while they build toward the minimums required for our 3 core programs. I need to stop here. There are times like an IRA, and there are plenty of, like an inherited IRA, we have plenty of clients, the actual client themselves, who says, I've got an inherited IRA, my mom just passed, it was only 30 grand, can we trade that? And the answer is no, I can't trade that in CG, DS, or GI because those require a minimum of 125,000 with the options hedging. All right, so we created this. Now, I was able to trade $25,000 portfolios at Interactive Brokers. That's one of the few benefits that IB has that Schwab doesn't, but it's not a problem. We get around that by having this mini portfolio. Okay, makes sense? So CG is aggressive growth with hedging. We covered that. GI, we're covering next week. That's growth and income, balanced growth with income. And we're going to talk about the income component as a teaser in about 10 minutes. And then DS is discretionary strategies. Already mentioned this, hyper-focused on AI, quantum, and Mag 7. And then our brand new 4MP. I number them so that they sort correctly in a list, if you wonder why the number's there. ETF only. So we have clients that come in with a Roth beneficiary. We got like a half a dozen of those, another half a dozen of people with IRAs. Or someone that's just turned 73 and, hey, I got to take RMD, but I don't want to take this money. I want to put it in a non-qualified account, but it's only 7 grand. Can you manage it? Absolutely, no problem. It goes into MP. So there you go. Now, this program, as I just described, is built as a bridge, and yet it can work as a destination. What does that mean? It means we have found some people, and this has only been out for 6 months, really 5, that go, I kind of like this. It's not as volatile as CG. It's more peppy than GI, which is mostly for income. It's not nearly as crazy as DS. Could I put 100 grand in this, 150? And I go, sure, if that's what works, but realize there's a price to pay, which I'm going to show you in the next 6.5 minutes, okay? So if you use it as a bridge, it's a client building assets, a younger client. We don't have that many younger clients, but we do have client children, a bunch of children that come in and they're contributing, socking away money, all right? But we apply our active management philosophy, all right? So if you want to use this as a destination, this is clients with larger accounts who prefer lower volatility. And I get the volatility. We're going to handle that in the next few charts, guys. But just remember this in the back of your mind. This is for smaller accounts, but we are finding that people that are less risk averse or more risk averse, less risk tolerant, are liking this portfolio. So the most volatile program we have is DS. Second is GI. Third is MP because there's no options hedging and there's only just a little bit of bonds, and then GI is the most conservative. GI, when the market just cratered today, was down less than 0.5% when the market was down 1.55%. All right. We'll get to GI next week. So full diversification. I don't have anybody that has all 4 portfolios yet. With enough money, you could do that. I think that this is going to generate a bunch of phone calls or emails, and I'm fine with that, guys. I want you to be allocated properly in a way that suits you. So there's 2 hats here, all right? The portfolio manager wants to maximize the performance, the maximization of risk-adjusted returns for each one of his portfolios, or hers, in Kathy Wood's case, or others. But the wealth manager, and there are fewer and fewer of those, I'll get to that in about 14 minutes, want to make sure that the asset allocation is correct for the client's risk tolerance. I can't adjust the portfolio performance to match the client, but I can adjust the portfolio mix. Hit rewind if you're home and you're not watching this, and play that again. All right? I can't change the portfolio's strategy operatives to meet your needs per se, but I can change your investment mix of our 4 programs to better fine tune to your risk tolerance. We only had 3, now we have 4. And I think it's a welcome change. Okay, so in its very limited history, when I started trading this, because again, I trade everything that our clients trade, in mid-September, it's up 8.2524%, and the S&P is up 7.4. That was 2 days ago. It's different now, but you guys get the point, all right? It's ETFs only, 1% cash, smaller accounts, can't possibly hold 10 to 14 positions. 96% equity, but there's an asterisk by that, and I'll talk about that in a minute. It's really 91. All right, 3% fixed income. It says started August 31st. We really didn't fund it till September. But here's the trade-off, and this is important. There's less S&P benchmark drift. That's a good thing for clients wanting more relative steady portfolio performance, but there's also less alpha performance. You can't possibly compete when I've got Snowflake and BlackRock and JPM and these mega companies on a day when the Fed drops rates or Trump says, we just signed a deal with Greenland, everybody's happy, no more tariffs ever again. And those holdings in my portfolio seriously could be up 7.5%, 8%, 10% in a day. I've seen it. I've seen it for 20 years where this happened. And that's why I have only the satellites in there, because they need to go into orbit when they can, all right? So larger accounts usually then belong in CG if you're looking for aggressive growth, or GI or DS, because that's where we add the most value. But it doesn't mean you have to do that. So let's walk through these holdings. SPTM, again, these are all ETFs, all right? This is the core holding. This is the equivalent to SPY in CG, and for that matter in GI, but we'll get to that next week. Broad U.S. market exposure, 1,500 companies, ultra low cost, year-to-date returns solid. It pretty much rides up and down with the S&P 500. This is the world developed countries, okay? XUF. X means doesn't have US in it. So developed countries means you're going to have Germany and Switzerland and France and Italy, and you're not going to have Pakistan or Uzbekistan or any of those, right? Just the developed countries. So it's a little safer from a currency risk position. All right, 33 billion of assets under management, 22% weight. SPYV. All right, this is the value ETF. So the growth portion of the market, these are companies that are growing, usually don't have dividends because they're growing, they're taking that money and reinvesting it to build more widgets. Value companies tend to be the P&Gs of the world, not so much Johnson & Johnson, but other companies that are just kind of cranking it out, all right? There's still a biotech component of the healthcare sector, but real estate stocks, all right? So this is designed to pick that up at a 17% weighting. At a 12% weighting is small cap value. This is the only asset class with a 50-year track record of actually beating large cap growth. So why don't we have this in every program? Because it's a really, really spotty record. I mean, terrible performance, underperforming growth by like 22% in some years, 3 years losing in a row, which Warren Buffett had as well. He's more of a value play. All right. And I don't think most clients want to sit through that. So that's why it's not, but in a small weighting, in a small portfolio, it is appropriate. JEPI, which is equity premium income. So this is actually fixed income. It can't be qualified as that because it does have stocks in it, but it's selling covered calls against these. So the dividend yield is 9% on this. How can you do 9%? Because you have a stock you're buying at 100 and you're selling a call at 105 or 110 to generate income. And when that expires, you keep that income and you sell another call against the stock. We do these sorts of things in experimental programs, but we can't do that on scale. And so we're buying this from JP Morgan to go in this portfolio at a 10% weight. It behaves like a fixed income, which is why if you add it to IGSB, the iShares 5-to-1 investment grade corporate bond, it's really a 13% weighting in fixed income and provides stability. Like today, it was not down nearly as much as the S&P 500, this particular portfolio. But on rocket ship days, it doesn't go up either. And I'm going to get to the charts in a minute. I'm looking at the clock trying to protect you guys here, but guys, I'm doing the best I can. So hang with me. It's all important stuff you need to know. So performance metrics. Let me get another sip of water. Have I missed any questions? Patricia, hey, CB3, listening for first time in light. Hey, Pat, how are you from SoFlo? Great to see you. So Pat and I, actually just like Pat and Nellie and I met sometime in the late 1800s, I think. I can't remember the exact date. We didn't know Lincoln, but we knew his son. Anyway, we've been friends for a long, long time. Wonderful to have you on the show, Pat, and all of you. So, but it's first time for Pat. So, all right, let's pause here. Let's look at this chart. This is a real performance chart from CG. Some of you on this call have been in CG longer than this, but many of you have been in since 2020. So that downturn there is during COVID, and then we literally rocketed out of COVID. So the CG program is in blue, and this is one of those times I have to go on camera. For some reason, I didn't get a single phone call or email for almost 2 years. I wonder why. All right, we just killed it. Okay, and I kept saying to myself, I hate to just pull back on this. We did not have the risk management strategies available to us that we have today. So you can see what happened after dwarfing the S&P for 2 years, year and 3/4. It then crossed down and stayed underneath. And it's because in 2022, we had that severe downturn. And I showed you that on the chart. Remember that red area that was grayed out? So, well, you can't gray out a red area that was redded out. All right. And then it's kind of been behind since then until this big downturn on April 12th. And that is really important. Why? Okay, I'm going to show you this chart again and show you this arrow. So look back, and I think those of you who've been watching this program long enough know, but the 3 lines at the top are where we want price to be. When the price, those bars are kissing those numbers, or kissing those well, it's numbers that the bars represent and that the lines represent, we're in a bullish mode. All right, when it pierces down below, we need to protect. We did not have the tools to protect then that we do now. We only had these option hedging since July. And then when we have this spike down, see the big red arrow in April, specifically April 7th, we were forced with our risk management strategies to sell quite a few stocks and stay in cash for a few days until Trump made his announcement and the market moved up 11.4% in one day, and we were in 55% invested, 45% cash, because that was the methodology that was available to us. It is important for you to understand, those of you that have been frustrated with performance, this kind of day, this kind of month, remember, these are monthly bars, not weekly, not daily. So every bar you see, every line represents a month. And you can see that except for the crazy fake out there in April 5th through April 8th, it was a pretty good month, but we don't know that. We don't know when the next 2008 is coming up. And I don't want to, if I may turn her into a verb, I don't want to Kathy Wood you guys, all right? And I don't want to Bill Miller you guys by just saying, it's a good methodology, it'll all come back. Not when we're, most of us, Andre, exceptions granted here, in our late 60s, early 70s, some 80s. No, not going to do that. Okay. So that's why we have a methodology that should prevent this next time or mitigate it. And here, this single chart is the most exciting thing I have to show you. This is from Koifin. This is brand new software that allows us to position our current holdings in CG and all our programs and look at what would have happened going back for up to 30 years. Now, I'm only doing 5 here because we've been using 2020. So what you will notice is And what makes this unique, I have to keep coming back to camera here because I know, well, Morningstar I can do, but no, you can't. You can't do it with the options hedging in place and back test the options hedging. It just hasn't existed. Okay. So that's what makes this so special. Now, I want you to notice how much closer CG would have performed in the past with our current technology of options hedging and monthly signals, and frankly, for selection signals. Now, you would have given up. Look again, wasn't that an incredible 2 years? No, sorry, 1 3/4 years, that blue line, not a single phone call because we were killing it. And DS is even more impressive, and I'll show you that in a month. All right, but most people would give that up to be able to kiss the index closer like this. And Heidi's going to send out a survey. You guys get this survey every week from me, every show. I really want you to fill it out this week. Okay, we're going to ask you these kinds of questions. Would you rather have, all right, performance like this or like that? I mean, they're just very different. Some people are going to say, well, we know you're going to come along and take it out again. Well, I certainly hope so. I'm positioned to with these satellites. You may have to wait for a little while because everything has to align. All of those 10 sectors and industry groups have to be performing great. Would this be more appealing now that we have the ability, before we even add an asset into a portfolio, we can back test it going back 30 years. What would happen if we dropped Rocket Lab and put in Caterpillar? Bloody, bloody, bloody. And we're doing that now. And how would that work with the options hedging? Just crazy technology that even 3 years ago we didn't have. And when I started in the business, of course, it can't even compare to that. Now, this is MP. All right. So it's tracking the benchmark really well. All right. But when the benchmark just takes off after 24, and 24 was a really good year for us, it just can't keep up. And those of you that were in CG, remember that we had a 29.6, let's call it 30% in CG and 35% in DS, just 2024. That's just 14 months ago. All right. So this is steadier, but you're going to give up some to the upside. Let's look at this in a 3-month return and just drill in here. So what if you say, you know what? CG is going to be fine for me. And you look at your account and there's the blue line and wow, CG, it's January 12th and I'm already up 11%. And that happened. And the market's only up 4. This is great. All right. And now it's trailing. Hey, what happened? It's only a month later. And I'll say, that is what happened. All right. But this is more likely what will happen with current holdings. We're still not going to exactly track the market. If you want to do that, you can just buy the S&P 500 and walk away, just like we said about 20 slides ago. But then you're assuming the risk and not your portfolio manager. Or you might say, well, I really like this MP program, mini portfolio, because look, it's beating the S&P 500. But if you invested in December, you're going to lag for quite some time. So where am I going with this? Where you look in the return compendium dramatically affects how you perceive your investment's performance. All right. It's got to be looked at over a longer time frame. It just does, guys. It really does. So I want to give you a quick preview on GI. And this is something we have not been able to backtest either. Let's say that you're looking for income, and that's why you're in GI. The reports at Schwab have not been able to show you credit quality. So you're coming to me and saying, look, I need income, but I want safe. I want everything in T-bills. Great. Are you going to be happy with 2.5% in yield? Well, let's see. I have a $100,000 portfolio. How much income? That's $2,000 a year. 2,500. Well, I need more than that. Okay, we're going to have to take a little bit more risk. Well, how much risk? Well, let me show you exactly what we're doing in this program. There's the credit quality. The highest, of course, being AA. The lowest, we're not going to do C, D, and F. Those are junk bonds. The maturity ladder, the longer we go out, 7 to 10 years, excuse me, is going to generate more yield. So the average yield in this portfolio, 2.02 years. All right. What sectors and income generation are we looking at? So corporate bonds is most of this. Corporate bonds yield more than treasuries because you have company risk, you have default risk. There is no default risk with the US yet. All right. Government 17%, cash 3%. And then these are our 4 ETFs that we're using right now, and that is their weighting. All right. We're going to talk extensively about this a month from tonight. Be sure to tune in for that. And we'll cover DS, which has the most impressive, but the most hideous drawdown, almost 50% in 2022 with DS. But if you hung with it, it was great. Again, I'm coming back to camera. It's so important that you match your risk with what we have available for. And you know what? You can mix and match us and other people too. We don't have any requirement on any of our clients that you have to put all your money with us. We do have account minimums. And it's because that's the whole reason why MPs developed. We can't trade 14 stocks in a $30,000 account. You can't do it. So, all right. So there it is. Koyfin, Schwab, institutional hedging, our signal system. That is how we're always adapting what we do to just give you the very best resilience to market downturns, income, and long-term, I want to insert there, risk-adjusted performance. The reason I have to say risk-adjusted is because if we just wanted the best performance, we could just put everything in Bitcoin, or we could short Bitcoin. That'd be the better choice right now. And crude oil futures, right? You could probably have a crazier return or do nothing but buy Palantir on margin. If you just say, I want to give you the highest return, you better run from that as fast as you can. Highest risk-adjusted return is always what we seek. I want to spend just a few minutes here. We're almost done. Hang with me, guys. People have said to me, so are you worried about being obsoleted by AI? Not for a second. Not for a second. I'm going to explain why, and it's important that you understand why. And if you know a friend that has a relationship with a wealth manager and they're banking on everything that the wealth manager is saying, they probably ought to be a little careful, and I'll show you why. So a wealth manager is someone that allocates to models someone else built. We have wealth managers, we did in the early years of our practice, that actually hired me to run their portfolios. When I sold my firm in 2014, I was on a really nice 7-figure retainer to manage their portfolios because they didn't want to do it. They just wanted the customer relationship and to do the financial planning. The problem is that AI can replicate 80% of this workflow today. It could not do that even 6 months ago, but today it can. I'm going to tell you why in just a few moments. So what do we do as your portfolio? We build the models, we manage the risk. I've demonstrated all that here. We run institutional hedging. And if you have a friend that doesn't understand that, they need to watch this video, not to become my client because my book of business is really closed. But he makes the call, he or she, when to hedge, when to lean in. That means get more aggressive, when to restructure. What's the value proposition? Judgment under uncertainty and risk control. AI cannot take the other side of the trade. That is what the takeaway is for you right here. AI is an intelligence academic system. It does not have feelings. It does not understand emotional downturns like today and dramatic sell-offs like Tuesday, which we're going to get to. All right. And it can't make decisions any differently then than it does when the markets are closed on a Sunday. Could that change? Perhaps in my lifetime? I don't think so. There's too many other areas to develop. So the central question is, for preserving the portfolio manager's role, who will take the other side of the trade? If I want to buy, are they going to be willing to sell? Or if I want to sell, are they going to be willing to buy? Or are they just going to see all that red on the screen and go, no, negatory? And then all of a sudden the markets dry up and we have limit down moves all the time because the exchanges are still going to enforce that. Okay, so Tuesday, this is 57 and a half hours ago, Altruist said, by the way, we have new AI software that is going to replace wealth managers. Charles Schwab dropped 9%. Now, those of you, including me, that are with Schwab, this does not affect them in any way in their clearing business. It's because for them to bring on new wealth managers, they're going to have a tough time with that because Altruist is bringing on those people that want to handle everything in all the wealth management piece in-house with their custodianship. So it wasn't just Schwab, it was LPL, Raymond James, Stifel, Ameriprise, and several of these companies have gone worse since then in general downturn, of course, to what's happening in the market. All right, so self-service financial planning is here, folks. It really is. I know one of my futures traders buddies, really sharp guy, I love this guy, said, yeah, this first year I'm doing all my taxes myself. Is reading my 1040s, my pay stubs, account statements. I still have to do really esoteric like futures trading statements with my accountant, but I'm giving them all the prep ahead of time, right? Retirement projections, Monte Carlo simulations, all of that. And it's literally saving people 40% of the admin time. So the client communications, they better be really good at that. Why are we protected on the right-hand side? If you think I'm going to be put out of business from these guys. Okay, Altruist AI is really the culprit here. They have nothing to do with trading. They are a financial planning tool, which is what wealth managers do. Interactive what-if scenarios. I fully think that I will be making this software available to you guys if you get tired of e-money. Now, it's not there yet because Altruist is not obviously sharing that they want to keep it all on their platform, but they're going to have to white label it so others of us can use that for people that want to just work with a portfolio manager and not a wealth manager. All right. So there's your central question, and we are almost there, folks. Who will take the other side of the trade? If I want to buy, AI is not going to sell. If I want to sell for sure in a down market like today, who's going to take the other side? We feel pretty good that in 2008, when these tariff shocks hit like 2008, that someone has to make the call. Are we going to hedge? Are we going to hold? Are we going to ride? Are we going to not ride? This is an emotional time. If you don't believe me, you need to watch the movie The Big Short. The language is vicious in it, but if you can get by the language, it tells you so much about what happened in 2008, 2009. It's a phenomenal movie. And unless you're in the business, I had to watch it twice just to get every single line. It's really, really good. You should check it out. So, all right, there you go. That is why we're always adapting to meet the market conditions. If you want to see what our performance is, you just go to our website, click performance. It's updated every month, usually the 4th or 5th of the month. All right. If you're new to the show, that means my old friend. Go there and subscribe, please. Click the little bell so that you get updates whenever we go live. You'll see us on Facebook. You'll see us on X. You'll see us on LinkedIn. I tweet every single day, sometimes twice a day. And we also have podcasts, which we're pretty much doing every week now, especially with so much going on. Our next show is exactly a month from tonight, same time, same station. Until then, I do live, as I just said. We're not live. Sorry, I'm live when I'm doing them, but you're not. And those usually break on Monday, sometimes on Tuesday. Like this next week, they'll break on Tuesday because the market's closed on Monday. So there you go. Here's my statement. I usually have one or two of these to finish the show. If you have something you want to ask, we got a 25-second delay, so just type it in the chat. In this investing business, the attempt to outperform all the time is usually a barrier to performing well over time. Thank you, Mr. Olstein, for saying that. And I always like to leave you guys with 2 Timothy 1:7. For we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. Guys, there's a lot here tonight. I'm exhausted. I don't know, you probably are too. It is so important to me that you understand what we are doing for you. And if you have challenges with that, we want to know about it. If you have misunderstandings about that, I hope you have less now than you might have had an hour and a half ago. You saw long-term performance from 2 mega stars with 8 figures of management, well in the tens of billions. Crash and burn. We're not going to do that. And it's because we're not going to take those kinds of chances. We may underperform from time to time, but my goal is to give you the best risk adjusted. It's not that my stock prowess has gotten any better. Frankly, those of you that have been with me for a long time know we have had some unbelievable winners. And I showed you on the chart to prove it. But what happens on the risk side? I have been focusing for 4 years and waiting for these most recent tools to be available. Back testing with Koifin and the options hedging with Schwab. I literally started looking for the next broker dealer in April of last year because of what we had to suffer through and the clients suffered through in those downturns because I had no hedging. All right, but that's all changed now. All right, I could not be more excited. And those of you that have known me a long time know I'll be 71 in a few days. I love what I do. We're good at it. And we have your best interest at heart all the time. I'm going to look in the chat, see, do we have anything here? Thank you. Appreciate your kind words. All right. Guys, that's it for tonight. Come back next week. Next week, I keep saying that. We used to do this weekly. But next month, all right? And we will go through everything you've just seen, except that we'll be doing GI, which is growth and income, and DS, which is our AI quantum Mag 7 stock. You can wait till then if you want, or you can check with me if you want to talk about reallocation. That's what we're here to do. We're here to serve you guys. We love you. Thanks for watching. I will see you in a month. Stay tuned, though, for the podcast and the tweets every day. Go with God.